EV sales are expected to hit 20% of all car sales in China in 2025. That's up from just 5% in 2020. And the same is expected in the United States. Holy smokes, this is a big industry shift. Hey everyone, me Kevin here. In this video, I want to break down my strategy for investing in Nio, Xpeng, and Tesla. Many of you know Tesla is my biggest stock holding, and it's been my favorite. Obviously, because it's gone to the moon. It just keeps going. But we've got some serious things to talk about. First, I'm going to talk about the S&P 500 inclusion risk for Tesla and my strategy surrounding Tesla. How much am I going to buy at what price breaks? We're going to break that down in this video. Then I'm going to compare the values of each in my strategy. So we're going to look at the difference between Tesla, Nio, and Xpeng, and we're going to do some simple comparisons. We're not going to go crazy deep here, but they'll give you the bottom lines. Then I'm going to talk about the delisting risk for the Chinese stocks, and this is an important update to some of my other videos that I've done on this. So let's get right into it. All right, December 18th will be the last day any of us can buy shares of Tesla before Tesla joins the S&P 500 on Monday, December 21st. Barron's believes that Tesla will make up about a 1.5% weight in the S&P 500 with a market cap of around $600 billion. This means that index funds will have to buy up about 17% of Tesla's outstanding shares to follow the S&P 500. This is the point of index funds anyway. Their goal is to match the S&P 500 and what it's doing. Now, many of these shares will likely therefore be bought exactly on December 21st. Even though funds could buy a little bit before and after, then they would in theory differentiate or sort of deviate rather from the benchmark, and they don't want to do that. Basically, if you're trying to track what the S&P 500 is doing, it's bad to try to make some trades before or after something changes. Most of them, my guess, are going to be trading on the 21st. Given that Tesla has risen about 55% since S&P 500 inclusion was announced, many of us believe that millions of stock traders and their moms and their dads and their children and their cousins are all riding Tesla into Friday, hoping it goes to the moon, so that way they can dump all of these Tesla shares to all the people investing in the Vanguard funds and all the ETF or index fund holders that are now going to be buying Tesla that weren't buying Tesla before, who can buy Tesla shares at these insanely exorbitant prices, potentially even as high as 700 or 750 if Tesla ends up rallying on Thursday and Friday like some people expect. Dump them to these index funds on Monday, and who cares if Tesla crashes? You just made your profit and you rode the Tesla wave. That's the trader theory right now. But the problem is, you never know. You never know what the market is going to do, and it's entirely possible that the market is going to do the opposite of what we fear. Now, I personally don't blame you if you're trying to ride the Tesla wave to make some money, because there's gonna be a swing. My guess, though, is there are gonna be a lot of people that are gonna make a lot of money, and there are gonna be a lot of people, probably an equal amount of people, who are gonna get hurt. But what I'm doing personally is I'm keeping money on the side just in case Tesla does end up crashing. After the Tesla stock split on August 31st, we had 1 or 2 more days of a Tesla run. Then Tesla decided, hey, our share price is so high, let's raise $5 billion in cash, which they also just did last week as well. But anyway, back beginning of September, they go, let's raise $5 billion in cash. And starting September 3rd, tech started selling off for about 3 weeks. It was a pretty painful September. Tesla ended up down about 37% from its peak. And some fear that this is exactly the same thing that could happen now. And if Tesla falls 37% from $630, where it is now approximately, that means Tesla would be just under $400 per share again, at $396, which is still insanely high relative to where Tesla used to be, but it's also a big painful drop for anybody basically who owns Tesla shares. Now, knowing that this is a possibility, it would probably be a smart thing to short Tesla stock or to play options on this because, well, I kind of think there's a greater chance that it's going to fall than it's not going to fall. But I'm the idiot who's not going to do that because I don't want to tie up my money on options and short-term gains right now. Just not the situation I want to be in for the end of the year. Instead, I'd rather see Tesla fall and then take that cash that I had on the sidelines and use it to buy at specific price targets. Now, I can make a whole separate video about why I'm not, selling calls or selling puts. I've been asked this regularly in the investing course and the live streams, and I answer the questions in detail. But for the point of this video, let's make it very simple. If Tesla falls below $550 per share, I will buy $100,000 of Tesla stock. If it falls under $500, I will buy $250,000 of Tesla stock. This means I'm not going to be bashful. Like if it goes to 550, I will buy 100K total right away. If it goes under 500, hey, dollar cost averaging down, boom, going in heavier, 250. If it falls under $450 per share, I will throw another 500 grand into the stock, which means I could literally be in for somewhere around, 100,000 plus 250 is 350 plus 500 is $850,000. If Tesla falls under $400 per share again, I would be willing, don't do this, but I would be willing to do whatever I need to do, including selling some other shares, to put an additional $1 million into Tesla stock. That is how insanely, maybe stupidly bullish I am about Tesla. And y'all know I hate selling. So those are my parameters. We'll see what happens. Now, I have not bought Tesla individually since the day before the S&P inclusion was announced. I vividly remember that day thinking, it's a little red day today. All right, let's do a little bit of a nibble into the stock. And I bought a little bit. That's kind of usually what you hear me say in the live streams in the morning, like, all right, it's red. Let's buy a little bit of this today. Let's buy a little bit of that today. No, I'm not going to buy that because of this. I can give you my theories on long-run investing here. And unfortunately, over the last, this year, the theories have been pretty dang profitable. So I'm very grateful. I mean, knock on wood that luck continues. But anyway, to me, $633 or wherever it is now for Tesla is a great price for 2022. Now, don't get me wrong. I'm not anti-Tesla here. And even though there are some quality control issues with Tesla, it's like, please fix these things. Yes, maybe do shut down the Model S and Model X line at Fremont for 2 weeks. So maybe you can fix some of these production issues. Who knows? Retool your lines, whatever. But if you want my opinions on Tesla's quality, just type this into YouTube. Meet Kevin, Tesla stock danger, full details. And I go through all of that. I even go through a lawsuit about the quality issues. Watch my video on that. It's really good, especially if you're a Tesla investor. You got to know that perspective. And if you agree with it, that's good. That'll give you a defense to kind of the quality control issues. If you disagree, then don't buy Tesla. Okay, for now, the short answer is I'm buying the dip hardcore. The more it dips, the more I'm buying. Moving on. Let's talk Nio and Xpeng, and then let's touch on that delisting risk. All right, so first, Nio and Xpeng. I like these as I call them balancing stocks to my Tesla. They're actually my favorite EV stocks to balance Tesla out with a little bit. Number one, they produce an actual product. That's good step number one. I know Li Autos is an option too, but it's just not as much of a focus for me right now as Nio and Xpeng are. Separate video needed for that. All three, Tesla, Nio, and Xpeng, they're obviously automotive manufacturers. They are EV makers, electric vehicle makers, and they all have autonomous driving systems. The autonomous driving systems, by the way, crucial. I will not invest in some EV company that does not have autonomous driving. I don't care about that. Anybody can do that. I need the autonomous driving technology. All three of these have also had secondary offerings in the last few weeks here to raise money. Now, obviously, we know that all of the EV stocks have been up substantially since the election, and Nio and Xpeng hit, well, currently the EV market where Tesla is not really focused, and that is on quality perfection. Tesla doesn't really do that, and Nio and Xpeng do try to focus on that. They're trying to get that higher-end customer that's willing to pay a little bit more for that higher quality service. Obviously, these are also Chinese manufacturers. They do not sell in the United States yet. Nio also focuses on something called battery swaps, which is really cool. It's something that Tesla tried out but decided not to do. Nio might even, at some point in the future, sell cars without a battery. So you can literally go swap a battery in and lease it. And then just keep renewing your lease on sort of a monthly basis for this battery. Now, obviously, you'd probably have to start with some kind of lease to get some kind of battery when you first buy the car. But yes, if you can picture a sales contract, you could, in theory, buy a Nio car in the future without a battery, which would lower the cost of it, and then pay for the battery as sort of a monthly subscription service. So that would give you the opportunity to have potentially a cheaper loan or cheaper monthly payment on the car, or maybe you pay cash for the car and it's cheaper and then you lease the battery. It's kind of an interesting model, separating out the battery and creating that as a subscription service. Now, batteries are expensive, so Nio's potentially taking a little bit of a risk there in that it's not like it's a software as a service where you're just dealing with software and some of your expenses are like some customer service people picking up the phone. These are actually batteries, which decay over time, obviously. But the more batteries get better and last longer, the less of a risk factor that would be for Nio, and I think that's the direction we're going, so I do like that for Nio. I don't see that as a big downfall, though, for Tesla not having that. Tesla did try that in America, and it seems like Americans don't like giving other people their battery and getting somebody else's used battery, right? They like their own battery. So maybe that was just a cultural difference as to why it didn't really work out in America. Now, Xpeng also focuses on quality like Nio, but what's really interesting about Xpeng is they're more interested out of all three of these in getting Lidar integrated into their autonomous driving vehicles, and this is something that Tesla refuses to do. Even Nio, by the way, has hinted at using Lidar for those sort of edge case scenarios in the autonomous driving. And honestly, I'm not convinced yet that we don't need Lidar, aka maybe we need Lidar. There are definitely some odd cases where when I drive my Tesla on autonomous driving, you gotta take over because the car's like, no, you don't get it, do you? Right? But then again, we don't have a full release yet of self-driving, so we'll see if Elon's systems can handle self-driving completely without Lidar. So far, so good, but we'll see how it ends up. Many say that this won't be an issue at all for Tesla. Just give the algorithm time to learn and get better and better. The machine learning is already so good and so many millions of miles are being driven without Lidar, we'll be fine. I'm inclined to believe that, but I'd like to have a little bit of a hedge too. This is also why I am not investing particularly in any kind of individual Lidar stock. There are a few individual Lidar stocks that are kind of like all the rage right now, and I did throw those, so I can read you those names here really quick. So Luminar, that's Luminar, is a company that conducted a SPAC merger, and they sell Lidar products, but they're pretty new in terms of the company. The other one that's more popular right now seems to be Velodyne. Velodyne, also a Lidar manufacturer. I generally don't go into part manufacturers too heavily, which I guess is kind of ironic because I am investing in AMD, in NVIDIA, and Qualcomm. But yeah, generally materials and products like this I don't get into. I get into more of that finished product. And I'm sure there are many of you who can add some commentary about other Lidar stocks you're interested in, but thought I'd mention those. Now, when it comes to Nio and Xpeng in my strategy, both of these stocks have sold off after I made my November 23rd video saying I'd like to buy more of these stocks, but they're way too pricey. I don't know if I caused that bubble to pop, which if I did and I caused you any stress, I'm really sorry about that. Now, as these stocks have sold off and apparently hit a low point on Monday, I did end up picking up more shares. I've probably been more heavy on Nio than Xpeng, but I've got about over 300K invested in both of them right now, which is still, scratches the surface in terms of what I have invested in Tesla. But, there are also foreign companies. I don't own the vehicle. I don't know the product as well, obviously, because I also can't fly to China right now. Got this thing called the pandemic going on. So anyway, I do have some long-term calls on Nio, not on Xpeng, and if you watch my buying alerts, either on this channel when I post them, or immediately in the course on building your wealth through owning stocks and the psychology of money, you'll get my alerts immediately. If you're in any of the courses, like the real estate investing course, of course, you'll also get the, I'll talk about what my trades were in the day in the live streams every day. Anyway, all those links are down below, and you could always email me for a bundle coupon code at kevin@meetkevin.com. Okay, so I'm invested in Nio and Xpeng, but what's the scoop here in terms of valuation? Like, how do we compare these to Tesla? So let's do that. Right now, Nio and Xpeng, they both sell for a decent premium over their competitor Tesla. And the easiest way to estimate this first off is just to compare them based on their future price to earnings ratio. And I'll just make this simple here with a simple comparison. Nio, in my opinion, sells for about 150 times their 2023 earnings, their net earnings, their bottom line. They sell for about 150 times that earnings for the entire year. Whereas Tesla sells for about 40 to 50 times their 2023 earnings. So you're paying about 3 to 4 times as much money per net earnings at Nio and Xpeng as you are at Tesla. Now, I know I kind of lumped Nio and Xpeng there. We're not going to go into spreadsheets in this video. The video is already long enough. But Things look a little bit better when you look at a multiple of revenue. This is a little bit dangerous, though, and I'll show you why. Barron's says that Nio is projected to hit a $4.6 billion revenue figure in 2021 and will hit $2.1 billion in revenue at Xpeng, and at Tesla will hit $45 billion in revenue. Now, what's really cool about this is if we line them up, and we'll pull them up on the iPad here, take a look at this. Tesla has a market cap of $600 billion with $45 billion in revenue. So that's about a 13.3 times 2021 revenue. Nio has a market cap of $61 billion with $4.6 billion in 2021 revenue expected, which is about 13.3 times. So these are actually oddly aligned. That's really cool. But there's a danger. I'll tell you about that in a sec. Xpeng has a market cap of about $39 billion in 2021, which is about 18.5 times earnings. So if you were to rank these in terms of value, you'd have Tesla, based on this multiple here, you'd have Tesla and Nio actually tied, and Xpeng being the most expensive. If you go based off price to earnings, Tesla is the cheapest by far out of all of these. And then you've got Nio, and then you've got Xpeng, which is slightly more expensive on a PE ratio. Now, future PE ratio, that is. So what makes Nio potentially dangerous is margin. See, this multiple is gross revenue, right? That's the top line number. But you got to go through the funnel, so to speak. And Tesla's funnel right now is more at scale and more efficient than Nio's. So Nio has finally gotten their automotive gross margin up to about 14.9 to 15%. This is good. In fact, I talked about that when I first started talking about Nio. I'm like, hey, look, they've only got a 5% margin right now, but we know this is going to go up into the mid-teens very soon. I guess 12%. They got up to 15%, which is great. Tesla sits around 23 to 24% without credits. Now, I don't think that just because Nio went from 5 to 15 that they're going to be able to go to 15 to 23. I think that's going to be the hard part. Like, they just got the easy part. Now the hard part is getting that incremental increase in production margin, so to speak. Now, Nio bulls say that Nio is going to become more efficient, and I believe that, especially in their partnership with their automotive manufacturer called JAC. This is a company that is 50% owned by Volkswagen and 50% owned by the Chinese government, which is very different from Tesla's vertical integration model, which at Tesla, and this is where the Tesla bulls come out, and they say, well, Tesla runs everything. Any kind of increase in efficiency, Tesla gets that extra profit. If JAC gets more efficient at their manufacturing plant, they share that profitability increase with Nio. And so you've kind of got this fundamental difference here that makes them both a little bit more difficult to compare. But I will say, because of this difference in margin, which is just a fact that we have right now, Tesla, out of all three of these, even at today's ridiculous price, is the cheapest. And that might be hard to consider given that Tesla's $660 and the other ones are in the $40. But remember, the actual dollar sign and price number is very different from the actual amount of earnings you're getting for what you're spending. And so obviously this is where Tesla, it makes sense that Tesla has the best value out of all three of these. But I'm bullish on EV, and therefore I'm bullish on all of these. For right now, my strategy is putting 5 times as much money into Tesla as I'm putting into Nio and Xpeng combined. That's my rule of thumb. But I am buying Nio and Xpeng. I bought a bunch yesterday, and I will continue to buy these. I also bought some options I mentioned on Nio, none yet on Xpeng. Both of these are higher than my price targets. I said that I'd prefer to be buying these in the 30s. Nio briefly hit $39, which I was able to go shopping for. I did buy some Nio at $39, but my average cost, I started buying Nio around $24. I did buy some Nio as it was falling in kind of the higher 40s. So I'd probably say my average cost is somewhere around $35, which is closer to my target. But I've been nibbling, and some of my purchases have been higher, closer to $50 even a share. But that's okay, because as the stock was falling, I was picking up more. And my goal is to get more money built out in this position, even if my average cost basis goes up a little bit over my target. Now, there are fears that the Chinese companies like Nio and Xpeng may disallow access to the PCAOB auditors to inspect their companies. This gets a little tricky, so I'm just going to bottom line this. Nio and Xpeng are Chinese firms. Congress just passed a bill that Chinese firms that are listed on U.S. stock exchanges must allow PCAOB registered auditors to be audited. It's kind of like the auditor is getting audited. Well, Xpeng and Nio use PCAOB registered auditors, but they don't allow another auditor to come in to check on their auditor. Basically, but like if you just ignore that whole summary there, basically, unless Xpeng and Nio change their mind, Xpeng and Nio would get delisted from the US stock exchange. Now, right now, Nio says they're compliant and they shouldn't be delisted, but they also technically have not yet allowed access to the auditors of the PCAOB registered auditors. Gets tricky. Now, the Communist Party in China does say that they are optimistic they will be able to strike a deal with Biden and that none of this is going to be an issue. I personally believe this. To me, I think the odds of Nio and Xpeng getting delisted are very low, maybe 3 to 5%. So for me, I'm going to be watchful, but I will not buy these stocks because of that. I'm going to keep them maybe a little smaller of a percentage of my portfolio because I got Tesla instead. But to me, it's just something to keep an eye on. Yes, there is still a problem. Keep an eye on that. It could be a big negative catalyst. It could also be, in theory, a very good positive catalyst once that gets solved by Biden's administration and his relationship with China. So we'll see how that goes. So my goal right now is simply to wait for the S&P 500 inclusion. Let's see what happens. Keep this in mind too. This is interesting. If Tesla ends up crashing, it's entirely possible that people are going to think something is wrong in the EV sector. They won't necessarily localize that to Tesla. And it's entirely possible that Nio and Xpeng could sell off as well. So I want to keep some money aside. Got that $35 cost basis on Nio. Willing to keep adding to that, even if it pushes my cost basis a bit. And ideally, though, have money ready for next week. Let's see what happens next week. And you know what? If they don't dip, no problem. Next time they dip, that's when I'll go shopping again. So there's my POV, just straight up putting everything out there on Nio, Xpeng, and Tesla. Thank you so much for watching, and folks, we'll see you soon.